The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're going to talk taxes. And if you got any issue that's come up, you say, what the heck is a 199 pass-through? We know. So you can give us a call, 803-0930, 803-0930, star 930 on your cell phone. And I got Chris Fabian, who I drug out of the office.
I thought, isn't that the new diet plan?
The 199
pass-through?
I don't know. The 199 pass out. Anyway, we were just here at the studios here, and we noticed it was snowing. Now it's stopped. That makes me so sad. But anyway, 803-0930, star 930 on your cell phone. You want to text us. Our text number is 3930, and we're talking taxes. So, like, whatever's happening in your world, we can help you with. We certainly want to help you. We got all of our offices open today till 5. Saturday, the McKinley Mall is open during normal business hours, and the rest of the week is going to be 9 to 9.
Right. And
McKinley. Tomorrow is Sunday.
Yeah.
Okay.
And they're open 11 to 5 tomorrow.
11 to 5, right. So, Chris, what you got to say to yourself?
Oh, well, be careful of New York.
True.
I mean, they're, as much as we say that's two sets of laws, but New York State is penny pincher right now. And so if you itemized on New York and you have heavy job expenses, don't be surprised if you get a letter.
Make sure you have your receipts.
Yep.
Because they're not going to pay. It's true that New York State will allow you to itemize even if you can't on the federal. However, they're not going to give up the money easy. So you want to make sure you have all your deductions. Now, if they send you a letter, you have to answer that letter. If you don't respond to their correspondence, then that means they're not going to pay you at all.
Yep.
On any part,
yep.
Right?
Yep.
So the important thing is, if you're getting a letter from the federal or the state, that is your move to make sure that you respond to the letter so that you can get your refund, or at least part of the refund. You want to make sure that you respond. If you don't, you lose everything.
It's
right.
Yeah.
All right. So we wanted to talk about, and again, you can call us at 803-0930, 803-0930, star 930 on a cell phone. You can visit us at all of our 30 area offices, our new corporate offices at 1890 Colvin. It is such a beautiful place.
It is. It is.
I mean, it makes me feel like I'm not working, sort of.
Yes. We're spread out. We
wonderful.
have windows.
We have windows and a skylight.
Yes.
Right. All right. Things to watch out for. Watch out for the 199 pass-through on investments. So for those of you that have mutual funds, you're going to find that you're going to have the qualifying, non-qualifying. You're going to have the capital gains distributions, the 250,
the 1250.
Allocation, and there's on many of them are going to have a 199.
Yeah, come on, they just made that confusing statement even more confusing for people.
What's that?
The 1099 DIV.
Right, that's true. So then, but the 1099, if your mutual funds qualified for business deductions, then part of that business deduction, that business income, that's part of your mutual fund, is going to qualify for the 20% pass-through. And so you want to make sure you take that as well. And don't forget that on that form also is foreign taxes paid. Yep. So really on that information sheet that you got from your broker, there's all kinds of possibilities on there to save you money. You just have to make sure that you do it, because if you don't, you're going to overpay. I mean, really overpay.
Right. And they're not going to send you a letter saying, hey, guess what? We owe you money.
Right. So on there, it would be your regular dividends. So don't just think that it's just dividends. Regular dividends and qualifying dividends. And that means what, Chris?
Well, your qualifying dividends get taxed at your capital gains rate, which could be, for a lot of people, I'm seeing is 0%.
0%. Then there's the capital gains, which also
is at
could
that
be at
same rate.
0%,
Yep.
right?
Yep.
And then the 1250 gets that's taxed at a higher rate, and the 199 is the qualified business income deduction, and that's over and above your itemized deductions,
Right.
20%.
Yep.
Right? Okay. I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone, and we're going to go to Chris. Hey, Mr. Chris or Miss Chris, how can we help you?
Yes, I am really closer to putting solar on my home. It's a small home, but questions that go with that is I understand it to be what they call a tax credit. And so my two-part question regarding the tax credit is I've heard conflicting information as to how long I can take to capitalize on that tax credit because we are a two-income household. One is a 1099, one is an employee. So I know that the employee, we have the federal tax wages increased to cover both of our combined income so that we kind of break even at the end of the year. So with that, how do we arrange our reduction so that we can maximize the federal and state tax credits that go with solar? How would I set up the W-2 with the one income that's an employee?
Well, roughly how much do you guys make between the two of you on your tax return?
Between the two of us, we are approximately 95 to 100.
Okay, so they have a tax liability.
Right.
See, here's the thing, Chris. When those people are selling you solar, all right, they're touting the federal credit and the New York State credit. Many people, but in order to use the credits, you have to pay income taxes. So you don't have do you have children that live with you?
No.
All right, and you don't have anybody. No one's in college, right?
Correct.
All right. So in order to use these credits, you have to have taxes due, and not FICA for your wife that's self-employed. You have to have income taxes due on both the federal and the state. So many people do not pay taxes. So when they talk to us, they say, "Well, we're going to end up with a 50% credit." 50% of zero is zero. So you have to make sure that you are going to have a tax liability to offset the credit against.
Which it seems you guys are. So what I would do is base it, because depending on the cost of the unit, is it $20,000 roughly?
Yeah, give or take. And, so back to the question is, we do pay taxes, and we kind of arrange it so that we break it.
Right. Yeah. So your credit, if it's around $20,000, is going to be about $6,000 on the federal. What you could do is basically, have your wife or whoever is the employer has the W-2 reduce the withholding to like 7 or 8, so you get most of your money in your paychecks. So you're not waiting for that money to come.
Right. So you get the credit. You're going to be able to use that credit to offset your withholding right now, and at the end of the year, it'll be more flat.
Perfect. How long do the credits? Say I was able to recoup $4,000 of that $6,000 year one. Can I carry the balance over into year two?
Yes.
Okay. And is it the max of year two?
I believe it's a 5-year max.
Right.
But it sounds with your income,
you should have no problem.
You might even use it all in
Right.
year one.
Right. Okay. And do you know when the NYSERDA benefit expires or runs out?
No.
No, we don't know. When you need to call with them.
Okay.
Okay, Chris. Good luck. Bye-bye. Yeah, and that's what people don't understand is that it all sounds so good that you're going to get this gigantic credit, right? And then you're going to have free electricity. But if you don't get the credit because you don't have any taxes. But here's the thing. If you find that you do qualify, you do have the credit and you did get solar, then that gives you an opportunity to take money out of your IRA and your pensions tax-free.
Yep.
Because you want to come up with money that you can use to offset with that. You use the credit to offset it. So it requires deeper thinking.
Yep, definitely.
Deeper
Planning.
thinking,
A
right.
lot of planning.
Okay, I'm Esther Gilius, the tax lady from EG Tax with Chris Fabian. We're going to take a short break, 8030930, 8030930, star 930 on a cell phone, and you can text us at 3930. We'll be back on the other side.
I don't ever wanna feel like I did that day. Take me to the place I love. Take me
Hey, I'm Esther Goliath, the tax lady. Frank's funking us out again. Frank, what is that? Who is that?
It's the Red Hot Chili Peppers.
Of course, it's the Red Hot Chili Peppers. Well, I'm the Red Hot Esther Goulias, and we're here to help you. I'm from EG Tax. We got 30 area offices to serve you. We're open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Our McKinley Mall office is open on Sunday. And if you need the very best tax help, EG Tax is there to help you, right?
Definitely.
All right. Let's go to Larry. And 8030930. 8030930, star 930 on a cell phone, and 3930 on our text line, and we're going to Larry. Hey, Larry, how can we help you?
Yeah, I don't think I have to file my taxes. I didn't pay any taxes last year. I'm retired, me and my wife, and I just wanted to go over the numbers to see if
That sounds like a plan. If you're how old, Larry?
I'm 64.
Okay, and you're retired on a regular pension or a disability pension?
Just on Social Security.
Or you have no other source of income?
My wife has a small pension of about $6,600.
And is she retired on a disability pension?
No,
Or just a regular pension?
that's correct.
Okay, then if that's your only source of income, you don't have to file.
I did take $5,000 out of a traditional IRA.
Okay, but if she's got 6 and you got 5,500, that's 11,500 plus your Social Security. You're not going to have to file.
Okay, do you recommend filing to protect yourself from fraud, though? I mean, if somebody else uses your Social Security number to put a claim in or...
Yeah, the only reason you would maybe have to file would be as if you're a homeowner and your town requires a tax return for the enhanced star.
Right.
Yeah, no, that's not a problem.
Yeah, I mean, you really don't have to file, Larry.
Yeah, the only other thing I'll throw out there is I'm on the Essential Plan with the help from your associate, Tim.
Yep.
And he thought maybe you should file just because you could prove your income.
Well, I mean, that is another thing. So it's not income taxes that need you to file, but there's all these other adjunct programs that say, gee, you want a reduction in your tax return? I mean, your property taxes, show us your tax return. Oh, you want the Essential Plan? We got to see your tax return. Yeah. So for that, I'd file, but you don't have to file for any other reason.
All right. So, yeah, it sounds like it'd be an easy file anyway.
Oh, it is. Yeah, for sure.
Do it.
Good, Larry.
Thank you very much.
Thanks for calling. Bye-bye.
I talk to my clients all the time. And I'm sure you're the same way. I tell them I never thought I would know so much about health insurance as I do, and I know taxes.
Yeah.
I mean, it's how bizarre that we have to really know and understand the health insurance
right,
law.
Because, and people don't realize that if you are paying a lot with your employer to have health insurance, that you don't have to take your employer's health insurance. There are people that are paying high health insurance rates that actually could get it through New York State at a much lower cost and better insurance.
Right. Or early retirees who pay COBRA for health insurance because they like that plan.
That's true.
But they're paying $800 compared to maybe
a month.
$20
$800 a month, right. And but people are afraid to drop their insurance because they think maybe they won't be able to keep it going. Yeah. But the truth is, the New York State may be going broke over it, but they're still in the health insurance business. And I will tell you, they have some phenomenal deals there for people that just don't have the income. I had a lady the other day. Now she has stocks and bonds of well over $1 million, but she's on the Essential Plan because she doesn't have any income, much income from them.
Yep.
And so it's not what you have in assets; it's what you have in income.
Yep.
So it's unbelievable. I'm Esther Goulias, the tax lady, 8030930, 8030930, star 930 on your cell phone. We got a text over here, Chris.
It does. It says, I received a Schedule K-1 from a 1065 on my Roth IRA. Where do I file it on my taxes?
Nowhere.
Now,
here's the thing. They do send out these K-1s on IRAs, and the truth is that's a trade within your individual retirement account, and that is not taxable until you take the distribution on a 1099-R. So when you get those, you just have to know that you don't report them. And if you've been reporting them, you need to amend the return.
Right. I mean, because they look like you see your name on it.
Right, and you think, oh, my God, they got it at the IRS. Yep. But you got to look at it says IRA, and so it means not taxable.
Or recipient's ID number. And if it's not your social, it doesn't go on
That's
yours.
exactly right. That's exactly right. Well, let's talk about the other thing is I want to talk about things people need to pay attention to is their cost basis. So if you have a form from your stockbroker that says that you had sales and you didn't think you had sales, do you just ignore it because you didn't think that you had sales?
Yeah. No. If it's on that 1099B, you better put it on your tax
Right.
return.
And you have to look, it'll say, it lists what you sold it for. Then there's a column that says what the cost basis is. If there is no cost basis, if you just report that the way it is, you're going to pay taxes on a full gain on that sale of stock. And what you need to do is go back and see if you can find out what the cost basis is, especially if you inherited it.
Right. Yep. I mean, if there's stuff under where it will say this gets reported on your Schedule D as cost basis reported short term, code A, and code D, which is long term, those are right. But if you have a B or an E, and I even see X, I don't understand why they're still using X. That's been gone forever. But that means the cost basis isn't reported. That might be wrong. Go through it. If you're just reporting what you're seeing on that consolidated statement from Merrill Lynch or Edward Jones or whoever, it could be wrong. There may be a cost basis that's not in there. So you have to go through that big package.
Well, you don't have you don't have to,
but you should.
But the thing is, if I came up to you and said, I would like $1,000, please, and you would say, forget it, right? Because that's a lot of money. When people are doing their own returns and they don't know what to do with this stuff, they overpay. And many times it's thousands, maybe multiple thousands of dollars because they don't know what to do with it. So instead of looking into it further, they just put what's down there. And so remember, if there's no cost basis, you want to make sure that you research the cost basis. And if it's a cost basis A or a cost basis E, you want to make sure that you double check to make sure that the basis that they have on there is correct.
Yep.
Right?
Yep.
All right. Then the other thing is capital loss carry forwards. If you're carrying forward, if last year you did your tax return with TurboTax, and this year you're using another software, and you had a capital loss maybe on your Schedule D last year of $10,000, and this year you're using a different software, they don't know to carry it forward. They don't know that you have a capital loss carry forward. And it's up to you to make sure that you list properly what your capital loss is. Otherwise, you lose the deduction.
Yep. And you know what I also noticed too, is if you say you have a loss of $20,000 and you don't have to file this year, say you retired, you're only on Social Security, you had no other, and you don't file that return, you're going to lose that carry forward loss. The IRS is going to say, "What?" When you go to the next year and you took money out of your pension.
But that goes back to planning again.
Yep.
See, if you are somebody that says, you know what, I'm just going to live on Social Security this year in my savings, so I'm not going to have to file a tax return. Well, why not take advantage of that large standard deduction if you're filing a joint return and take money out of taxable sources? Because in essence, you get it tax-free. Now, people are always scrambling, I want to do the Roth because it's tax-free. There is a lot of tax-free income that's available out there if you just do some planning.
Correct.
Right?
Yep.
Hey, I'm Esther Golias, the tax lady, 803-0930. 803-0930, star 930 on a cell phone. And our text line is 3930.
And we got a new one.
Yep.
Is the Obama health care mandate / penalty still in effect and still available?
Yeah. Well, it is in effect through 2018. However, they have liberalized I'm going to use excuses for the penalty so that if you felt like you couldn't afford it, if you had your utilities turned off, there's a number of excuses why you couldn't have your health insurance last year, which would give you an opportunity to have the penalty excused. This would be the year to use it. And next year, of course, there is no penalty.
Right. So on your 18 return is the last year
that
as
you
of
could
right
be
now
penalized
for the federal. We heard New York State is looking to implement that, though. So let's stay tuned to keep, as soon as we hear something about that,
Right.
We'll let you know.
Right, because Everybody's got to change the tax laws all the time, right?
That's right.
All right, let's talk about. People don't even understand about the pass-through. When I'm doing a tax return, I say, here's your income, here's da, 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 and here is your pass-through. It's 20% of your net profit from this particular business. And they go, what are you talking about? And I had one the other day. It was $52,000. You know, it was a gigantic pass-through.
Yep.
This is a deduction. So if you had self-employment income of $80,000 on the bottom line, you're going to get a $16,000 pass-through.
Right.
Right? If you have a partnership and you're a partner and you performed a service and your partnership income's $40,000, you get a pass-through deduction of $8,000. I mean, these are deductions. And again, we talked at the beginning of the show about if you have if you're in a mutual fund that invested in businesses, you could get on your income statement from your broker, it'll mention that there's a pass-through, 199 deduction. Again, that's a deduction. So you want to make sure that you understand. If you have any questions, you can give us a call. I'm Esther Golias, the tax lady. We're going to break for the news. 8030930, 8030930, star 930 on a cell phone. Esther Golias, the tax lady, and Frank's got us dancing on the tables here. Esther Golias, the tax lady, from EG Tax with Chris Fabian, 8030930, 8030930, star 930 on a cell phone. We got a couple more texts that came in.
Yes. First one says, what if a mutual fund has merged with other funds over the years? How is cost basis determined?
Well, it all depends on whether you have sold any of but let's just make it simple. Let's say originally you had mutual fund XYZ for $10,000, right?
Okay.
And then it merged with this other company and you put nothing else into it. Then you had paid $10,000, it stays $10,000. That's
right.
Your basis.
Yep.
Then if you buy some more ABC, who used to be XYZ, and you put another 5 in, your basis is 15. Nothing. I mean, it makes no difference if it merged. Did you get rid of any? Did you put anything into it? Did they give you a return of your investment? If not, if you put in 10 and another 5, your basis is 15. If you put in another 10, your basis is 25. If you sell some, then you have to determine the cost per share, average cost per share, and then you would adjust the cost basis appropriately if you sold any. Right?
Yep.
Right. All right. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on your cell phone. And all right. So talking about these pass-throughs, I mean, they are a lot of money. A lot of money. So if you have rental property, as a matter of fact, your rental property, if you use it as a business and you're using the safe harbor rules, that you're using it at least 200, you're spending at least 250 hours a year doing it, and you have separate bank accounts and you're handling it as a business, that you can use the pass-through on that as well.
Correct. You know, and that's the big thing. You got to be using it as a business. And that's where it's tough. A lot of rentals, though, don't have profits. I mean,
right, unless they've been around for a while.
Yep.
Right?
Yeah. So, and if you have a loss, and this goes through for businesses too, if you have a loss, you claim the loss on your tax return, but that QBI will take that loss into consideration next year.
Right.
So that could reduce your QBI deduction next year. So
because all of these things that qualify for the qualified business income deduction, the pluses and minuses are all being carried forward. And the interesting thing is, this is brand new.
Yep.
I mean, for as long as it's going to be in, who knows, you know. Anyway, we got another text that came in.
It says, married filing joint below 189K income. Any tax return / refund benefit to opening a Roth now before filing?
All right, there's no benefit to opening a Roth at all, not from a tax deduction standpoint. The only benefit is in future because the Roth will grow completely tax-free, and if you keep it in past age 59 and a half, then it's just completely tax-free forever and ever and ever, but you don't ever get a tax deduction in the year that you open the Roth. So,
right. I mean, if your income is above 190,
that's why it has a 189.
Yeah, right.
189 to 199.
Right. I mean, if your income is above that,
then you can't put it in the Roth.
And you can't put any more in. You can do a backdoor Roth where you put money in as a non-deductible IRA and then recharacterize it over to the Roth
later.
I mean, because you know you're going to... And the whole thing is planning, like we've said how many times. What is your income going to be when you retire?
Right.
Are you going to be in a similar tax bracket now or a reduced tax bracket when you retire? And if you're going to be in a reduced tax bracket, why are you putting in a Roth now? Because it's costing you money.
Well, right now, you don't pay any taxes until your income exceeds like almost $27,000 if you're a senior. So people that are self-funding in their pension funds, if they're self-funding, when they go to take it out, in most situations, they're not going to pay taxes later. So you have no tax benefit now, and you're not going to pay taxes later. Now, it is true that if you kick the bucket, and we're all going to kick the bucket, then your family that inherits it, they will pay taxes on it. But you get nothing now. Nothing.
Right. They'll inherit it tax-free.
Right.
Right.
Well, that's why I said they won't pay any taxes.
Oh, I thought you... Okay.
Right. So if you could have put away $500,000 and gotten a deduction at 20%, you would have saved well over $100,000 in taxes. But if you put it in a traditional IRA, but if you put it in a Roth, it's just gone. So, and God knows what they're going to do in the future, right? Anyway, I'm Esther Gilius, the tax lady. 8030930. 8030930, star 930 on a cell phone. The other thing is that we see this year is tracking mortgage interest.
Yep. Because you got to pay attention to your mortgage. You have to pay attention to your home equity loans.
Right.
You got to say, what did I do with the money?
The money. So if you have a mortgage to acquire, it's going to be deductible.
Yep.
If you have a second mortgage to improve, it's going to be deductible. If you had a second mortgage to acquire your house, maybe you borrowed the money for the down payment, it'll be deductible. If you have a second mortgage to buy a car or pay off credit cards, it won't be deductible. If you've blended the two, you have to go back and track how that was all calculated. So that makes itemizing more difficult on the federal. On the state of New York, they're A-okay with it.
Right.
Yep. And then the other thing is I don't believe your friends. I have had more clients tell me, I hear you can itemize this year. Yes, you can itemize. There are medical taxes, which include state and local income taxes, property taxes, foreign taxes that cannot exceed $10,000. Your mortgage interest that you pay on your primary and secondary mortgage and your home equity, provided, like I just said, that it went for the house. Charities are deductible, and casualty losses if you were in a federally declared disaster area. So those are still deductible. What's gone is miscellaneous itemized deduction.
Right. Yep. Your employee business expenses,
That's
your
right.
broker fees, that's all gone. And it does hurt, too, with the limitation of the $10,000 for salt.
It's just terrible. The $10,000 salt deduction. I had a couple the other day that had $18,000 in property taxes, and you might say, wow, they must be rich. Well, the truth is they bought a house for their kids because their kids can't afford it. And so they're paying their property taxes, and they got a cottage down in Ellicottville, and they're paying taxes for their kid, and so they ended up with a lot of non-deductible property taxes as a result. Anyway, I'm Esther Gilius, the tax lady. 8030930, 8030930, star 930, and a cell phone, and we're going to go to Arthur. Hey, Art, how can we help you?
Hello, this is Art.
Hey, Art.
Hi, I've already filed my 2017 taxes, and I received the 1099-Q, the letter Q, for a 529 distribution.
Okay.
Do I have to amend my taxes now and include that 1099-Q?
Was
it all depends.
Yep. Was it used for education?
Yes.
Okay. Yeah. This is where the IRS gets a little bit tricky because there's no straight line on the tax return that says how much was your distribution, how much was your education. But they do have worksheets for you to prove that was
But the
used
worksheet doesn't go to them.
But the worksheet doesn't go to them.
So the bottom line is if you used that for education on the federal, there would be no income. However, on the state.
Was it from a 529?
Yes, it was.
Yeah.
Okay. Can't take the education credit on New York State for
Well,
those funds used.
Right. So let's say you had a kid in college and the tuition was $25,000 and you took $8,000 out of your 529. Then
Correct.
and there was no other scholarships, and this was all for tuition, you'd subtract the 8 from the 25, and there still would be plenty to use for New York State, to use the New York State Empire State credit, okay? But let's say that the tuition was only $10,000 and you took 8, then you'd have to limit your deductibility of your New York State credit by that $8,000. So you have to do a computation.
Okay, so the other question is, I didn't claim this child on my taxes, even though she's 18.
Why, Arthur? Why not?
She got claimed on her mother's.
Oh, okay.
Okay. All right.
So, do I still get to do anything with New York State if I'm not
No.
dependent?
No, you're good.
No.
Mom would get
But you
it.
should really talk to the mother. I don't know if you talked to her, but you should let the mother know that you got this, because let's say she took the full $10,000 on New York State and you got a $5,000 529 contribution, which would make that incorrect, and she would probably get a bill from New York State later.
Oh, I see. Okay.
Okay?
All right. That's great. Thanks.
All right. Thanks, Art. Bye-bye.
It's
yeah.
Yeah, divorce is not fun
Yep.
when it comes to taxes, but the
But I want to tell you something. If you can get mom and dad together with the kid, and that the kid understands that that they should not file their own return, because especially this year, the first $12,000 of income your kid makes is like tax-free.
Yep.
So if your kid is claiming is saying, I'm going to do my own return because I'm in college and I want the credit, they really don't get the credit, number one, legally. And number two, there is no taxes due, so there's like no savings. But mom and dad would save like with the family credit
$3,000
over
to.
$3,000. It's $3,400 with the family credit, because the kid doesn't get the family
Well,
credit.
25, yeah, with adding New York State
Right.
in. Yep.
So it's unbelievable. Anyway, I'm Esther Golias, the tax lady from EG Tax. You know we want to help you. If you want to give us a call in studio, 803-0930, 803-0930, star 930 on your cell phone. If you're getting letters, make sure you call EG Tax. Don't just pay it.
Please don't just pay
Don't
it.
just pay it. All right, let's go to Joanne. Hey, Joanne.
Hello.
Hey, how are you?
Hi. Good. How are you?
Good.
So I'm planning my deductions for next year.
Yes, good girl.
So this year, my husband is retired. This year, he's 62. He started to collect his Social Security. And I'm still working, and I make about, I'll be $105,000.
Okay.
Should I plan that for next year we're going to be married filing separately or married filing jointly?
I would still think jointly is better, because even if you do separate, 85% of your husband's Social Security is going to be taxable.
And if you itemize, he's going to, of course, less problems this year.
Right, but then you got to look at the tax rate for you. How much extra taxes are you going to pay at married separate compared to married joint?
The only way you can know, really, Joanne, is to do it both ways. Probably jointly is going to be better.
Oh, okay.
Okay?
Probably.
And the other thing is, since your husband's retired and you're still working and he's so young, he can use the spousal IRA and put $6,500 away next year.
Oh, okay.
So that would be a great benefit. So if you're in the 20% bracket, thereabouts, you're going to save like $1,400, $1,500 when you consider the state of New York by putting money into a traditional IRA. So that gives you another tool in your toolbox when you're planning.
There's some part of Social Security income that is not taxed, right? Or
It's the maximum is 85%. So 15% at your level won't be taxed.
won't be taxed.
And then, of course, on the state of New York, it's completely tax-free.
Oh, okay. So 15% on the federal,
Won't be taxed.
tax-free on New York State.
That's correct.
Okay, great.
Thanks, Joe.
All right.
Bye-bye. Hey, we're going to go to Larry in Georgia. Hey, Larry, how's my favorite guy?
Hey, sweetie, I tell you, I'm always blown away by yours and Chris and Tiffany's encyclopedic knowledge of tax.
That's us, boy. What can we help you with, sir?
Okay, I'll be brief. Number one, I just express mailed my 1099s to you, Chris.
Okay.
Very quickly. Number two, I'm going to email you my statement. Number three, at this point in my life, Chris, is it prudent and practical for me to invest in my
IRA?
In my IRA, right? In my yeah.
It's all going to depend on your net self-employment. You know, if you have a loss or your contributions may be limited there, Larry.
Yeah. Chris, my net self-employment was like, I just had one client very low. So if I hear you, probably it's not cost effective, not prudent, I guess.
Correct.
Worth it.
But you got to look at the numbers.
We got to look at the numbers first.
Okay.
Yeah. All right, Larry, where are you going this year?
Well, this year, bless your hearts, I'm heading to Singapore, Thailand, Cambodia, Vietnam, and then Hong Kong.
All right, Larry. Well, you have a great travel year, and we'll be in touch with you shortly, okay?
Thank you so much.
Thank you, sir. Love you, Larry. Bye-bye. I'm Esther Golias, the tax lady from EG Tax. I guess we don't have any time. Do we got another
No, we got
text?
time. We got another question. Okay. Capital gains and qualified dividends are taxed at lower rates.
Right.
But they increase AGI and cause higher IRMA deductions. Any advice?
Nothing you can do about that.
There's nothing. Take all your money out and put it in a mattress.
Right. I mean, there's nothing that you. I mean, because that's the difficulty with taxes is one thing affects another. And I had a lovely lady the other day that came in, and she was very elderly, and she had a sister that gave her $3 million. And so when we were all done with her tax return, she was kind of upset, and she said, you know, she wished she would have never got the money. I said, give me your $3 million and I'll pay the taxes. Yeah. I mean, that's the bottom line.
Right.
It is true you're going to get a little better this way and a little better that way. But unfortunately...
Yeah. And for those who are listening, don't
I mean, if there's nothing that you can do, nothing you can do.
IRMA is the increase in your Medicare through Social Security.
Right. And it does go up, but not that much.
It can go up to $450 a month.
A month, right? But it's
compared to $130.
Right. Yeah, that's true. That's
but
true.
I mean, you got to maybe reshift your income. Maybe if you have an IRA, you do direct contributions.
Okay, that's a really good suggestion. You know, the direct rollover to a charity, like if you're somebody that gives to charities every year and you're doing your required minimum distribution, instead of it ending up as income on your return, you can do a direct rollover from your IRA directly to the charity, and it doesn't end up as income on your tax return.
Right, so that could help
and
bring
that
down.
helps IRMA.
Yep.
And Pete, too. IRMA and Pete. All right, let's go quickly to Marianne. Hi, Marianne. How can we help you?
Hi. I received a lump sum pension payment this year where 20% was withheld in federal. I got about $235,000. And I also received, I will be receiving in 2019 about $20,000 in severance pay, where 20% was withheld. Just trying to get a little hold on where I might be tax-wise. New York State for my 19.
All right. Are you saying in 2019 you got the money or 2018?
I got it this year. 19.
In 19. And so you said 235,000 and 20,000, right?
Correct.
So 255,000.
And 20.
All right. So is this all in the form of wages?
No one was a pension.
Well, 235 was pension.
All right. So have you rolled it over?
No.
Why?
Pay bills.
Oh, honey, you don't want to pay bills with pension money. How old are you, Marianne?
58.
All right, so you got to be 59 and a half to not have the 10% penalty. So you're looking at, with the state of New York, you're looking at over 40% on that 235,000. So you're looking at like 100,000 in taxes. You want to pay 100,000 in taxes?
No.
Then I would roll it over, dear.
No. Okay.
This is like I had a gentleman the other day that took a lot of money out of his pension in order to invest in the stock market, and he lost it all. And he lost all of his pension. He had to pay the penalty and the taxes. It's brutal. You don't want to do it. You got to roll it over.
Okay.
Okay, hon?
Thank you.
All right, thank you. Mamma mia. Okay, let's see. Let's do this quick. We got Dan.
Yes.
Hi.
Hi, can you hear me all right?
I can. What we got?
Hey, listen, my son got a scholarship to go to Florida, a school in Florida. He also gets a stipend to work there. And in his summertime, he also works in different states. This summer will be Massachusetts. Last summer was also Massachusetts.
Yeah.
Do I have to file a state return for each of those states?
It all depends on how much he earned in those states and whether he had withholding.
Oh.
So there are minimum filing requirements everywhere. New York State, all the states have minimum filing requirements. If he made like $600 in Massachusetts with no withholding, then I wouldn't file the return. But let's say that he made $6,000 and they took out $1,000 in taxes. Well, that's way too much, but let's say they did. And he files the Massachusetts return and he owed the whole $1,000. You're going to get a 112R credit on New York State for taxes paid to another jurisdiction. So he definitely would want to file the Massachusetts return so he can get the credit for taxes paid to a foreign state.
And Florida has no state
taxes, right?
Right, so there won't be any with there. So would I just file
You just would do your New York return and
Massachusetts.
He has to pay taxes on all the income earned in Florida as well as a New York State resident.
Right. Okay.
Okay.
Massachusetts may be a gray area depending on how much was.
How much he made. Right.
How much he made and how much. Okay. Great. Thank you.
Thanks, Dan. Bye-bye. Okay, let's go to Fred. Hey, Fred.
Good afternoon.
Hi. What can we help you with?
Well, you're talking about selling stock, and I'm talking about long-term gains.
Yep.
Stock that was bought years ago, and it's sold now. And we found a chart online, and it seems like they said that if your income was less than $77,200, you didn't have to pay tax on the gains from your stock.
No.
You have to show it, and it's going to bring up your other income. The gain itself you may not pay tax on, but the other income you're going to pay a higher tax, and not to mention New York State.
Right. I mean, you have to report it on the Schedule D. And so you may not be paying taxes at because you're under the 15% bracket, but it makes your other income go up, just like that our texter said, that it increases the other income you have.
So you claim your gains?
You have to do a Schedule D, long-term capital gain, and with a zero basis, it's all going to be taxable.
Okay. So whatever's on that sheet that says gains.
Yep.
You got to do it on a Schedule
D.
Yeah,
and you know, Fred, we're not looking at what you're looking at. If you want to come into one of our offices, we'll be very happy to help you. Okay, sir?
Okay.
Thank you, sir. I'm Esther Gilius, the tax lady from EG Tax. We're going to take a break till next Saturday. If you need the best tax help, give EG Tax a call. We have 30 area offices to serve you. We love serving you. Thanks a lot for listening. We'll see you next Saturday. Bye-bye.